all about it. Thank you, mate.
Okay, good afternoon, everyone. Russell, Holden and I will be taking you through things this afternoon, along with Andrew Robinson. As you well know, we adopted a draft annual plan in February of this year, then went out to our community to consult and get their feedback. Part of that presentation today is about that feedback. We'll also be looking at the overall financial position that we're in and seeking your advice on how to change the draft based on community feedback, as well as some external factors that have intervened since February. We'll also step you through the staff recommendations on individual topic items. The context, this is familiar to you. I think you've seen a bit of this before, but it's fair to say we're in, yet again, an unusual position. In this case, we're still dealing with a lot of the hangover from COVID. There are mixed views in both the media and among the pundits and the subject matter experts about our long-term economic outlook as a country, indeed the global economy. Geopolitical influences are at play, more so than usual. We, like almost every organisation in New Zealand, excuse me, we are looking at significant cost escalations, especially around construction materials, labour and skills around construction. And that's combined with high inflation that has been sustained over time and is likely to be sustained over time. Employers are also struggling to attract and retain talent. That's true of almost every organisation in the country. And we, as a major user of contractors and suppliers, are suffering the side effects of that as well. There is what is politely termed there a limited appetite for taking on additional risk. The market is cautious at the moment, and it's very conscious of its capacity to deliver. So, long story short, what this means is we have to be very wary of forecasts, and indeed most forecasters are being wary of being too concrete themselves. Nobody really knows exactly where some of these factors are going. And we need to take that into account when we're looking at these numbers and these plans. So, as signalled, these challenging circumstances are not going to go away anytime soon. The focus of that is especially around the deliverability of the capital program. It needs to be a size we can actually deliver in that environment. We need to balance the interests of individual wards with the city as a whole, which is a given in any planning process. The direction from Council late last year was to maintain our levels of service, and that's been factored into the planning you're about to see. And we also need to balance affordability with responsible stewardship of our asset base over time. Lastly, there has been a QV revaluation. As you know, that's not conducted by the Council, but we have to use the revaluation figures that are in it. And that has had a somewhat extraordinary result for the city this year, in the sense of the much higher valuations on residents and business. Three Waters, as everybody knows, the directions from central government have been variable, but the position the council has taken on this is that we will continue to maintain and fund Three Waters at a fit-for-purpose standard as we set in the last LTP until the transition occurs. So they're the fundamental principles on which this annual plan is built. The second stream is the feedback from the community. And look, I won't read that line by line. I know you're aware of it from the briefings, but what emerges as a theme there is that there's quite a lot of variety and diversity in the opinions we're getting back, even on particular subjects like transport or roading. There are very often two camps and almost equal in size on a lot of these topics. On balance, one of the key themes was that households are feeling the pinch, obviously. Equally, there were some who were saying, you know, you can't afford to duck important issues on the basis of affordability. There is a focus on the basics and core services, although what a core service is seems to vary from one person to another. It's not a clearly defined term. Climate change and response through climate resilience, definitely a theme running through the feedback. Transport, another major theme, but there's been a bit of a shift in the nature of those submissions from maintenance, purely a maintenance view, potholes and so forth, through to transport infrastructure, PT infrastructure, footpaths, streetscapes, cycleways. Residents of the East continue to express frustration, and I think that that's been a subject that's been very well explored here in this chamber. And again, we've been reminded about the value of community facilities and partnerships. There's a hell of a lot more detail available behind this analysis than we can go through in the time we've got today. That's available to you on the Big Tin Can app and on the web. We've had a lot of questions from councillors this year. I would say far more than usual. There's nearly 200 have been received, and the bulk of those have been responded to. There's a few still waiting response due to complexity. But if you have any queries about how to use that Q&A database or where to find things, please just let me know. Now, Russell Holden, Head of Financial Management, is here to step you through the financial side of the plan.
Thanks very much, Peter, and good afternoon, Mr Mayor, councillors. So just a wee bit of stepping back, if you like, and some of the things that Peter's already spoken about we're playing through here. So at the start, we were looking at a rates increase of 14.6% in extraordinary circumstances. OCR had jumped several times and has continued to do so from that point until recently. Inflation, of course, was going skyward as well. There were some supply chain and delivery concerns that were impacting the budget. So what did we do? So across the organisation, we reviewed all expenditure and programs, making sure that only things that were necessary in there. So we applied an inflation factor, but that wasn't just a simple equation of putting one factor across all expenditure. We looked at expenditure types, and we also looked at where inflation was contracted. So where we had contracts where there was inflation provision in there, we applied that. Where that wasn't the case, then we looked at, okay, can we absorb some of that within the business? So we did that. We looked at the borrowing costs across the organisation. So I guess I'm thinking particularly in the renewal space, where we have a strategy of moving from loan funding to rate funding that by the year 2031. So within that projection, there were some bumpy bits. So we looked to smooth that. So that took an element out of the next year and pushed it out. Still maintain our strategy, but we just looked to smooth that. We looked across staffing. Quite, you know, it's a big expense of council. So we looked at vacancies. We looked at those vacancies that we have. Do they need to be filled? And on when do they need to be filled? So a number of those we decided no, as an organisation, no, we can do without that. See how we manage that. And others we decided to put on hold for a year to decrease the cost for the coming year. So they aren't in next year's. We also looked at the vacancy factor. So that's where staff will leave and then we replace someone. Normally there's a bit of a gap while we do that, as Peter's already outlined. Still now there was delays in recruiting. So we increased that across the board. And so that got us through, like I said it quickly, but there's a lot of work in that. And I'm just at the pointy end here now, and there's a whole team of people who have worked extremely hard to get to the position. And to get that final step down to 5.68, we used tax credits with the subsidiaries, so subvention payments we call them. So that helped reduce the rates down. It's a one-off approach that we've taken, but we put that in, and that's how we ended up at the 5.68. So since then, what's happened? Well, the OCR has continued to increase. In fact, we're still, I guess, impacted largely by outside factors. So I'll just run some of those through those now, just on the slide in front of you. The NZTA, so we were able to get the NZTA subsidy on surf projects. So that helped bring the rates increase down. like I said, there's the number of outside factors. Some were positive for the rates position, and some were negative. So these ones are positive. The rating-based growth, we had another look at that, and we won't know exactly what that is until the end of this month, end of June. But we've taken a pretty strong stance on where we think it's going to be, and so we were able to reduce the rate requirement for the current ratepayers by that amount. We looked at our opening debt. Well, we reassessed what our opening debt was going to be, just given where the capital program is, the level of borrowing required, and we were able to reduce that coming through. Also in the capital program, the timing mainly through Te Kaha, a project that's going ahead of budget and of time. We've been able to purchase some materials to ensure we can deliver when we can. So we've been using Crown funds quicker than we thought. So Te Kaha, we utilised Crown funds first, and then council borrowings will come in at the end of that. So, but what that means is we're going to have to use council funds sooner than was initially budgeted. So therefore we have to pay for that. So that's put an extra increase on rates for next year. Living wage announcement. So we had made provision, of course, in the budget for that. But when the announcement came through not that long ago, of almost 10% increase on where it was, we had to readjust budgets because we hadn't provided that level of provision. So that's why that's there. We'll also looked at the salary provisions that we had in the budget at that point, and also just with the current market conditions, there's needed to be an increase to that provision. Three water costs. I'll cover more detail in that in a minute, but that's put a significant increase on what was going to be required for next year. So that leaves us to the 7.88 position where we are currently sitting. So just on the three waters, the team went through that just a couple of days ago, but it's mainly driven around compliance and cost escalations coming through specifically in the three water space. So those items are outlined on there. We also looked at the budget for the revenues coming through, and they were optimistic at best, I would say. So we've had to realign that with actual where we expect it to go. So those two things together, the increased costs and the reduction in revenue, is an impact of just over $6.5 million, so 1.18% of rates. Speaking about rates, I'll just invite Andrew Jeffries to come down, and we've put together a number of slides on the rates impact, what it looks like across suburbs, what it looks like for individuals, but I'll get Andrew to run through those. And
Great, thanks, Russell. Okay, so this first slide shows the average residential increase based on suburb, and this reflects our 7.88% rates increase. You'll see we've got suburbs like Central City and Avonhead on the left at between 0 and 2% rates increase, all the way over to Woolston, Ferrymead, Bromley on the right at around 14%. And we remember that this essentially reflects the revaluation impact this year. The suburbs on the right have tended to go up in value by more than the suburbs on the left, and that directly leads to this distribution, I guess, of the rates increase. The next slide is the same information but presented in dollar terms, and although I guess we've got still the Central City and Avonhead on the left hand side, there's a bit of a change on the right hand side. Woolston has sort of moved about 6 places inland there, and now on the right we've got suburbs like Akaroa and Merivale, which are getting increases for an average property in those suburbs of around $500. say, and that reflects that those suburbs are, tend to be higher value suburbs. Again, I just emphasise that these charts are based on our assumption that we've got the UAGC at 153 and the business differential at 2.22, which is our staff recommendation and what we consulted on. This next chart just takes a little step back from the above ones, which focused on rates increases, and this one actually just shows the rates, plain and simple the rates. And we've got FY23 in the blue and next year in the orange. And what we see here is, the range of rates paid by different suburbs, or really the average house in each of those suburbs. And it goes from Linwood, which this year is paying, say, around $2,000 for an average Linwood house, up to an average Fendalton house, which is probably $6,500. And we can see the orange bar shows the rates increase for each of those suburbs. Oh, yes. Yes, so just if we go back. So, for example, if we look on the left-hand side there at places like Woolston, which is 3 in from the left, you can see that rates increase there. That, remember, Woolston was right on the right-hand side of our percentage increase diagram. That's about a 14% increase. But you can see in dollar terms, it's quite a bit less than some, and it also remains one of the lowest rated suburbs, if I can put it that way.
Thanks.
This table takes 4 actual properties in the city. I've chosen them so that they're reasonably representative of suburbs. The left one is a low value, a low increase in CV property. At the bottom of the orange, you can see that first property's increased 39% in value at the revaluation, through to the right-hand side, which is 59%. And that is reflected in the bottom row in the rates increase for those actual properties. And I think one point to draw out is the second to bottom row, which is the dollar increase. And again, this is the same point that that second from the right property is actually, while it's going up 11.5%, it's actually going up more in dollar terms than the one on the right. This is a similar table, but now for some businesses. Obviously, there's a huge variety in business properties, so that middle one is a big CBD office building. I've taken a reasonably small suburban shop on the left-hand side and an industrial site on the right. And again, these are ordered from left to right by the impact that the revaluation has on them. So from 16% to 26%. And that is reflected in the bottom row where you see the percent increase in rates for those properties.
Before you go to the capital programme, Andrew, could you just reiterate for the public's benefit that we actually do not receive any more rates, as in the pie? If you just talk about that, please. So
in the revaluation, the average increase for residential properties in Christchurch was around 48%. And a lot of people do think, does that mean my rates are going up 48%? The answer is no. Our rates are not, our total rates take is not affected by the revaluation. But the revaluation does mean that some suburbs and some properties that go up by more than the average will tend to pay more rates.
Thanks, Andrew.
Good afternoon, Andrew Robinson, not Jeffries this time. So just I want to start at the beginning and just remind ourselves where we came from in some of the earlier briefings late last year. The LTP 2021, the current LTP that we're in, had some quite ambitious plans in there for the core capital program, and we started from a point of $596 million. And as we developed the draft annual plan, we made quite a big shift, a significant shift, to reduce that in the tune of $136 million to get our core capital program down to that sort of $460 million figure, which is where we're at today. I'll elaborate on that a little bit further. And that sort of supports some of the discussion that Peter's had earlier around some of the macroeconomic forces and such like, and also this deliverability concept to make sure that we put up a plan that we can actually deliver on, so we deliver what we say we'll do and make it more achievable and deliverable. So there's been some minor changes since that 460 million's been put up, and it's sitting around about 463 today, or as actually 25th of May, a couple of days ago. So that's the figure we're sort of landing on at the moment, and I'll expand on that a little bit further and introduce the balance of the capital program, which brings in those major facilities, especially the Te Kaha project, which changes the total figure. So these figures were really around the core capital stuff. So core capital is 463. The total program, however, is 728. That figure includes the Te Kaha contribution going into next year. So it's a demandingly achievable program for the year 3 of our current LTP period. I'm just showing the changes there on the right-hand side of that table. We're showing how core capital went from that 460 position when we went out to draft, to consultation with the draft, and there's some minor changes to plus 3 million to get it to 463. And on the other side, with the rephasing of Te Kaha reflecting the good progress there and the earlier spend of that money, we've gone to 728 million for that. Just note as well, for every $82 million of capital on any given year, that has an impact of about a 1% increase in rates across a 2-year period. So that's the sort of scale of impact on capital changes. What I'm doing on this set of tables is just showing the main changes that have occurred with some rephasing, and I'll pull out an example just to explain. So I'll go to the bottom table first. If you look at Matatiki, 5 rows down, there's been a change in the current plan there, where we've taken $4.2 million red brackets in FY25 and pulled it into FY24, because it, again, just reflecting the cash flows and the progress of that project. And then when you go to the top table to find that same project, you can see the actual spread of that project and the provisions in the plan. So it's showing 16.4 million for Matatiki in that year. So you can follow the changes and then see the end result up on the top table. A couple of things of note, where you can see the Grasmere projects and Better Off funding. That's external funds that have been introduced to the program, and while they have very little impact in FY24, they've put an additional money in the total LTP period to the tune of 30.9 for the Grasmere Acceleration Fund that comes from government, and the 11.8 Better Off funding as well. So that shows that impact across the wider period beyond FY24. This is a snip of the tables and schedules that support the presentation, showing how things have moved from the plan that was published for consultation on the 10th of March, and how it's moved in that way that I've just described for the what I call version 2. It's a work in progress version as we just try and land on this final figure through these remaining days for striking the plan. And it just shows across groups of activities where the dollars lie for the total 728 million in FY24 and future years, and it shows the changes. And the detailed schedules support this with project by project lines. There's a lot of lines in there, 1,000 odd projects that roll up to this level. This one's showing the comparative uplift from where we're seeing the performance and forecast for this year ending 30 June 2023, we see I'm talking back in core capital terms now, 390 million or thereabouts we think it'll land this year. And next year the budget is 463 million. Key things to note there is a reasonably significant uplift in the transport and waste sector of the pie there. That's the grey bit. So 110, we think it'll land about there this year, ending 30 June. And next year we have a budget of 146 million. Reasonably sort of consistent across water with a bit of organic growth there, a little bit of growth in parks and heritage. Some of that's supported by things like the Robert McDougall Art Gallery grants, Akaroa Wharf, Ngāpunawai Car Park, those sorts of things that have got some fairly significant projects in their parks and parks, heritage and coastal programs. I've included this slide today to start talking a little bit about OPEX here as well. This one's come up as a result of recent discussions around the residents survey, and it's honing in on a particular part of the transport program, specifically the road renewals and maintenance areas. I'm going to ask Lynette, Alice and Steve Guy, I think both, to just come up and elaborate on this a little bit further following recent discussions.
Lynette, have you actually got your voice back?
Maybe you're going to give it to Steve.
No, I'm a little bit disadvantaged today, so I'm going to let Steve talk. Sorry about that.
We'll be hearing Steve's dulcet tones then.
We did set this slide up overnight, pretty much in response to the questions. I do understand there was some conversation yesterday about the percentage of network. Look, we've still got some more work to do, and that we're looking to set that well up for a good discussion in the lead into the long-term plan around the percentages. I just couldn't do them overnight. I'm sorry. I'm going to let Steve carry on.
So, good afternoon, everyone. So I'm just going to talk at a very high level of what you see up on the screen there, and I can answer more questions afterwards if you want to as well. But generally what you'll see there is on our capital expenditure, our capital budgets, we've got a significant increase coming into next year. Now, it's been a bit of a challenge, this year because we had a number of new contracts that started this year, and it's taken a little bit of time in order to get those contracts up and running and delivering. But when you think about the next year's focus on there for our capital funding, you see a significant increase in the resurfacing of both pavements and footpaths for renewals, as well as an increase in pre-resale repairs and vegetation control. So that's where the majority of the focus is going, and it's been led primarily where we've been utilising the information that comes back from resident satisfaction surveys and things like that. Then also in the operational side, you'll see on the operational side, on the right-hand side, we've managed to do a whole load of work where we've really streamlined a lot of things that we do deliver to refocus where we can spend money that adds the most value. And you'll see there in the 23-24, with the increases we've got going across the networks, that again, the same thing applies. This time it's in that footpaths and the drainage, as well as sweeping. So, you know, we've had a lot of information, feedback from residents about cycleway sweeping and things like that, and the vegetation control. So you can see there, just at a very high level, the spread of what we're going on about OPEX and CAPEX for next year.
So in order to feed back after your conversation yesterday, there is already a lot gone into this annual plan to try and step it up for next year. And that builds on top of the extra funding that you've put in for the footpath crews as well.
That's good. Yeah.
Good, thanks. Good.
Questions?
Yep. So this one is just showing some of the quite recent changes that have occurred across the Transport Capital Program that have gone through various committees recently. The Horsell Junction Road change only has a 563k impact in amount in FY24, and it's been neutralised by substitution of other projects, which has gone through an earlier council meeting. Coastal Pathway has an additional $5.5 million in it, recently confirmed, with 1.4 million in FY24. Now our schedules will be updated at the next working revision, which will hopefully be the final revision after all the debates and amendments consideration. We'll do another version to reflect those changes. And also briefings yesterday at the Finance and Performance Committee talked about the Cycleways program as a whole. I just confirmed that there's zero impact there as a result of those discussions in terms of any changes in FY24, and some of those considerations for additional funds will be considered in the LTP period going forward. Things never stand still, of course, and there may be some other changes down the line that could arise from the amendments process. Running out of time for external funding opportunities, it's probably more of an LTP issue at this point in time. Fine-tuning of work programs, and I suppose there's a couple of big things that, which, while they might not impact the striking of this plan, they could impact in the year ahead around the wastewater treatment plant and organics processing plant, which you've had a lot of information on separately. So they won't. There's no change in this current plan, but those things might materialise as the year unfolds, and they'll be dealt with through the normal delegations process and council considerations. And of course, we've got the bringbacks. Sorry, Peter, just the carry forward and bringbacks, the final year end wash up to do when we get to that point and when we know where all the actuals have landed. But our target there is always to make that a minimal impact on any further change to the program that's been agreed, and it will only likely fine tune things. We'll be targeting a zero or minimal impact in the number that you'll see for 24. I'm just outlining some risks here, and I think Peter's probably covered them pretty well with some of those earlier sort of global macro influences, but they're very real to our capital program. Probably a couple of just to call out that we've had some challenges with around what I call on the top line the third party impacts, and some of the challenges and delays we've experienced through the Kiwi Rail work that's impacted particularly on some of the transport program. But we're working to build and understand that relationship better at a senior and political level to make sure that doesn't sort of get in the way of things too much further. And some of the challenges we've had around the consents with ECAN as well. So with good planning and good communications, hopefully those can be mitigated. And I don't think, just glancing down there, the rest have been covered pretty well in the sort of macroeconomic stuff. So that's a bit of a high level summary through the program. The schedules that support this work are detailed, and the way that I've laid them up is to do a comparison against that 10th of March version, which was the one that went out to consultation, and our updated version was dated 25th of May with everything that fell into place by that date. And you can look at the comparisons and changes there and track each project to see how they've been changed, if they've changed, and where the money lies in 24 and years beyond. Yeah, thank you.
That's it for capital. We now move into a series of major themes that emerged from the consultation and the a summary of what we heard back from the community, as well as the staff recommendation. And thankfully Russell's here and Andrew are here to talk to the technical specifics around some of these. In the time we have, it won't be profitable to go through these line by line, but the staff recommendation here was to do no change from the draft. I don't know if either of you want to offer any overviews of these as we go.
No, I think that's fine what you've covered, Peter.
Yep. Yeah. Okay. The same approach here to receive further advice during the 2024 LTP process prior to making a final decision for qualifying suburban centres. All of this information will be available on the PowerPoint that you'll have access to, as well as the community. The UAGC, we've discussed it already. There's been a variety of information presented there. There was support for setting them at 153 and support for dropping to 50. You can see the split there, and the staff advice is no change from the draft.
Andrew will talk to that.
Yeah. I can talk to the next slide. So. So this slide just outlines the main reasons for the staff recommendation in relation to the UAGC. Staff are recommending a UAGC of 153, which is a slight increase from 145, which it is this year. And you'll remember we consulted on a UAGC of 50 as our alternative. So the reason why we support 153 is just recognising our fixed charges are already very low compared with other councils, and I've got a couple of slides to illustrate that. Also, we do have other assistance for low-income ratepayers. In particular, there's the government-funded rates rebate, which this year is $700. And that typically increases by CPI each year. They don't announce very far in advance what the new value is, but I've got a chocolate fish on it being 750 for next year. Just a quick CPI calculation on that one. And we also remember that there's the rates postponement policy. So anyone over 65 automatically qualifies and can have their rates postponed, and we collect that eventually when the house is sold or they exit the postponement scheme. Yep, good. Just one other relatively minor point, but charity-run retirement villages, things like Archer and Thorrington, that are run by a Baptist church trust, are non-rateable under the legislation. We don't, have any flexibility over that. I guess that's a government decision or a parliament decision. So again, that's something to remember in relation to low-income ratepayers. If we do reduce the UAGC from, say, 153 to 50, there's quite a few properties benefit from that are, small properties will benefit from that. And there's almost 2,000 utilities, which are typically, the small Orion boxes, will, obviously benefit from that, as will things like storage units and garages, car parks, and vacant land across the city. Just looking at the roughly 2,000 utilities, that would benefit those utilities by around 0.2 million, and that 0.2 million then needs to be found from other ratepayers. This table down the bottom has got 3 residential ratepayers of different sizes. They all increase in the reval by that average amount, that 47%. So this doesn't have the suburb story. But you'll see the average ratepayer, the one in the middle, is almost unaffected by the UAGC change, which is kind of what we'd expect for an average house. A low-value house at $400,000 would get a benefit of around $48 per year, and a high-value house would get a benefit of, would pay an extra $61. I want to just show our fixed charges in relation to other councils. We've had a look at 35 councils and their fixed charges. You'll see Christchurch is second from the left, so we're very low in comparison with most other councils. It's only Wellington that is a little bit lower than us in relation to fixed charges. This one here presents the same information as before, just on 9 councils, and I've ordered them from north to south, kind of, looking at the big cities, and then with Selwyn and Waimak on the right-hand side. Again, the blue bar shows the fixed charges, and we and Wellington are very low compared with the other major cities. And it's worth remembering that even those other major cities like Auckland, still the fixed charges a smallish proportion of average residential rates. For us, of course, it's even less. Okay, this chart takes a little bit of orientation to understand what it's showing. You've actually seen before in this presentation the blue bars. The blue bars are exactly what I showed in a previous slide. It's the percentage increase in rates for each average property in each suburb. So we've got the central city and Avonhead down the bottom, and Woolston, Bexley on the right-hand side. We're going from sort of almost 0% up to about 14% is the blue bars. The orange bars show the same information, but if we had a UAGC of $50. And remember that when we changed the UAGC, we also changed the business differential down from 2.22 to 2.11. So there's an adjustment to the business differential in there as well. The story of that is you'll see on the right-hand side, places like Woolston, Bexley will go down from 14% to maybe 13%. And other suburbs, I think about 5 in from the left is Fendalton, which is our highest value suburb. And that would go up from about 4% to almost 6%. So this chart does need a little bit of meditation sometimes to get the full benefit out of it. But the next one shows the same information but by dollars. And immediately the one that jumps out at you there is in the middle there with Fendalton. And you see that in dollar terms, that's a big change for Fendalton when you move from the UAGC of 153 to 50. Now the properties on the right-hand side of this diagram are the Mayor Vales and Akaroa, which will face a high dollar increase regardless, but if we reduce the UAGC, they will go up further. I think that's it. Thank you.
Thanks, Andrew. So just moving through some of the last of these major themes. Again, Capital Endowment Fund, the option of using $1 million or using $500,000. The staff recommendation was no change from the draft. There's a little bit more detail on this one. This is obviously the daily water allowance one. The difference between the 700 and 900 litres. Probably what's notable there is the submissions, which were pretty much exactly the same for and against. Very divided feedback from the community there. Probably worth mentioning that this is not a poll or referendum. This is simply the submissions that we received from those who are interested. So the 400 odd people around the city who felt they were obliged to submit. I'm not sure if we want to open any further discussion on this, but there is some further information here. I'm not actually qualified to speak to this. Brent was here a moment ago, and I can extemporise while he's not here. The supporting information. Oh, here we go.
Pete, I do note that it wasn't exactly 50-50.
It's pretty close. But
Just talking about that stuff yesterday.
Okay.
Sorry.
Brent, are you okay to come up and speak?
No, Tim's going to.
Oh, okay. Sorry.
Yeah, sorry, was there a specific question?
We're
or?
just running through it.
Oh, okay. Right. So yeah, this is our oldest slide now, so it's last summer's or last year's information, but it's basically just calling out that on the right-hand side, so the red area, the top 4% of users use 23% of the water. The middle section, 17% of properties use 30%, and then there's the lower numbers. So it's just calling out that most of the charging does affect those really high users that do use a lot of water. There are obviously some really high numbers on the right hand side, so they generally suggest leakage, and a lot of those have been resolved over the previous sort of 6 or so months. This talks to, I suppose, decrease in water consumption. So we've got results for mean and medians, and it's just calling out that we've seen a steady decrease in demand. It doesn't have numbers from February till now. I haven't updated those, but looking at those the other day, on average, if you jump to the next slide, it is sitting around 10%. So we've seen a 10% decrease in consumption. So it's shown that the introduction of excess water charges there, that 700 litre amount, has really made a big difference. So then it's just talking to a couple of the other benefits. So with that reduction in demand or usage, it means that we can defer some capital expenditure. So we don't need to be building new water treatment plants and wells, and we can potentially remove or decommission some other water pump stations, which in future will help, meaning that we don't need as much treatment and capital expenditure on that.
Thanks very much, Tim. It's for that. Jumping down. So, where are we now? So, like I said, outlined before, currently we're sitting at 7.88, and if we were to reduce the excess water charge from the 900 litres plan down to staff recommendation of 700 litres, that'll drop a further 0.12% off rates, so the potential position for a rates increase is 7.76.
There are some other themes that there's just some observations from staff there around cycleways. I know you're familiar with this material, so I'm not going to really line by line it. Obviously, there's a focus on delivery of the current program. I'm probably not going to ask Paul Annette to try to speak to any of this. I mean, the process is set out there, put forward as candidates as part of the long-term plan for public consideration and adoption. I think if there are any specific questions on this, I'd field them and refer back to Lynette to provide advice back. Wheels to Wings, there's a current council resolution which is verbatim up there. That's been put up exactly as per the resolution, so that's the current position. Just let you absorb that and then move forward to stormwater and land drainage. Brent, I don't know if you wanted to speak to the sort of funding side of this, but you did have a solution around that.
Yes, I've replied to a couple of specific queries on some of the roading ones. We do have funding in the long-term plan for addressing some of these. The issue from the previous briefings was around the prioritisation of those, but we'll commit to doing the scoping exercises on two of the worst areas, which were the Newport Tenby one and the Brenchley Ave, in this, so that we can fully inform the next LTP.
Now, I know this is a topical piece of information and you've been through it, so again, it's just reiterating what you already know. And lastly, there's already commitment to funding for new access and car parking, and there is also a priority around the approach to the long-term plan, which we will start as soon as this annual plan is concluded, so within the month. There are complex resource consent requirements, though, that should be noted. Now, there were a lot of other items. They were just the key themes. There were some smaller ones. We believe that we've captured all of those in the 190 odd questions and responses. If there are any other specific matters that haven't been addressed or you need information on, just sing out using that Q&A process, and we'll come back to you with a staff response.
So this is just a recap of the position that we are in today, taking us from what we went out in the draft for consultation and the changes and impacts on those factors through to down to the 776.
Just on possible amendments to the annual plan, I mean, obviously we're doing the adoption of the annual plan 27th of June, which means the reports around it are not far away from being due. We received about 52, I think, amendments from councillors. Thank you for being so prompt on that. We're working through the staff recommendations and legal advice on those. We hope to have them to you for, we believe, Tuesday, Wednesday of next week. It means that we'll be able to give you fulsome advice about the financial, risk, legal or other implications of those amendments. I should note in passing that quite a few of them seem to be not so much amendments to the annual plan as items for noting towards the LTP. So they're still being addressed. We'll still provide the information, but they're really more inputs to the LTP process. And as I said the other day, obviously, if you do intend to propose an amendment, you'll need a seconder. And if you need assistance on how to word the resolution, the council support staff and if necessary, legal support staff are available to help you get the wording right, so you don't have to improvise on screen on the day. From here, there's a fairly mechanical process. We're seeking final direction today on what should be in the draft. If there's anything different from what we've put on screen, we're basing that on the advice we've had, but if there is something different, we kind of need to know today. From here, we go into a very linear process where we submit the report to the Audit and Risk Committee for them to assess whether or not a fit-for-purpose process has been followed. And then we go to releasing the council report to the community, and you go into adopting the plan on the 27th of June, which will be on us before you know it. So that's really the state of play on all the major issues and our financial position.
Well done. Right. Thank you very much. We've got Lynette, Stephen, 2 Andrews, Peter, Russell, Tim and Brent. Thank you very much for your input, and it's been very good. I'd just like councillors, if we're getting stuck into these questions, to keep questions subjective and relatively short, because there might be a whole lot of them. So the first 2 are Victoria and then Jake and then Yanni. Sorry, 3. And James.
Thank you.
Yes.
I'd like to talk about the risk to the capital delivery. I wonder if you could put that slide up, please.
Sure.
That one and the previous one, noting that there are these risks to the capital delivery. What allowances have we got to buffer those risks? Where do they sit? Or is it just we'll deal with it as and when it arises? I'm just trying to understand where there is room to move.
Yeah, no, that's a good question. So where projects are already started, so that means they've got their budgets drawn down and they're underway. They might be in construction, but they might be in early stages of investigation and design as well. Mm-hmm. They have a budget that's set and accepted by the PM, project manager, at the time that they're initiated. And in that budget, they would be making an estimate of what allowances they need for various things, for fees, for consents, for construction, and they'll be doing a risk assessment on what they see the risks are to their project. And they'd be
Can I just stop you there, Andrew, because I do understand the contingency allowance that we have in those budgets that are already for projects that have already started. It's for the things that haven't quite yet started. You gave a couple of examples like the wastewater treatment and the OPP, and they were identified, I think, in the previous slide as presenting some risks, and that we can expect to get further information later in the year. It's just trying to understand how we deal with those potential increases at a later date from a contingency perspective.
Yeah, I'll go at that in two ways. So beyond projects, which you understand, which is good, would have programs as well. So programs are allowances of money for types of work that are going to occur. They're, if you like, a funding stream that you can draw down on for things that get defined as the year unfolds. So in a sense, that holds a level of contingency and allowances for funding things that we haven't quite started yet. On those two bigger projects, there are provisions in the LTP period. I think councillors are aware, I think the OPP is about 40 million across, I think it's that provision, but you've had briefings on where OPP is heading, and that budget provision hasn't been ultimately set yet because the solution's not ultimately defined. And the same goes for the wastewater treatment plant. There's negotiations going on with insurance, and until those are resolved, the solution won't be known. So there's a provision for both those things, but they're really for projects that haven't been fully defined at this stage.
So without going into further specifics, my question then is, are you satisfied and comfortable with the levels of contingency that we've got built in for our capital program going ahead?
With those two provisos specific, because they're two quite significant projects that are not yet defined.
Yep.
The capital program is structured in such a way and has enough agility and fluidity to fund things in the near term, and the LTP looks at things longer term. Yep. So we can balance things as we go, and that's the benefit of having sort of like a program management type approach. Nothing ever stands still. Things are able to be moved, and you get when one thing falls behind, you can replace it with another because you've got this suite of projects and programs that you can draw from to keep the momentum going.
Thank you for that. I've got two other questions. One is in relation to council recommendations. I see that on your slides, we've got recommendation for some of our big ticket items around the UAGC, around the water, around the business differential. But when it came to all those other themes, we don't have any council recommendations. I just want to clarify that recommendations will be coming in respect of some of those other themes.
I'll just move through to them.
What we have is we have staff comments provided in relation to all the other themes, but on the big ticket items we've got very clear recommendations, and on the other items we've merely got comments.
I think it's largely because these items don't have a particular clear decision to be made. They're topics. So the ones that were earlier have a very specific decision to be made about whether it's, say, $1 million or 500,000. These ones are more informative around a topic. So there's no actual decision to hinge upon.
So I think the CE knows where I'm going with this because I've asked it several times, and I just want to confirm, please, that in relation to Wheels to Wings, we had staff confirming and agreeing to the recommendation for that resolution, and I'm just wanting to clarify when we can expect to receive information from the transport team as to whether they continue to support the resolution that was in the annual plan.
So the Councillor Henstock, in the element in terms of Wings to Wheels, there is already a current council resolution which has been passed. That is clearly stated on the Wings to Wheel element, and that is the council's position, and that remains the officer position because that's what you...
Yep, water 700. Okay, keep moving through other slides. Next one. Next one. Okay, so what we're seeing here is we've got these stats for how we've seen the water use decrease, and then you go on to say that without the demand management measure, we're going to have to do these other things. It seems that your comments are in relation to at the 700 or not at all. So what we've been trying to do in the annual plan is consult on whether we increase the daily allowance to 900. We're not asking to do away with it completely. So I'm trying to establish what your best guess is in terms of the decrease. So all we talk about is a decrease of more than 10%. I'm interested to know, what do you think the decrease might be if we were to raise the limit to 900? Because there will still be some decrease And I'm just not seeing any information about that. It's either one or the other. Have I missed something?
Council, we'll have to try and run some more figures for you just to confirm we can do that.
Well, I think it's really important to be able to see that information, because we're not saying no charging at all, and we've had some great results. I'm just trying to understand a little bit what the net effect of that will be in terms of some of the savings that we were making if it was increased to 900, because I haven't seen any of that information yet. It's just my last point on that.
Thank you, Jane.
Yeah, answer my own question. I no longer have a question.
Oh, sorry.
Yeah.
Sorry. Yanni will make up for your...
Yeah, I will. So,
Well said, Yannick.
Well done.
so I just wondered, we had a specific resolution to consult on the changes to the surf and the craft and the transport projects, and I just wondered what feedback we got on that. Is there a kind of, because we've had most of the other issues have had a kind of, a feedback of the summary of the feedback, sorry. But we don't have any information about what the views were around those deferrals. And I just wondered, is there a way that we can see what people submitted in that regard?
I think we're at a loss. Are you referring to a specific question in the draft annual plan about craft and surf?
There was there was a specific council resolution when we deferred a number of projects to seek to consult through the draft annual plan on the proposal to defer a number of projects so that we could fund the surf. And so I'm just trying to understand what the feedback was on that consultation as a result.
I'm not sure.
So I think we'll need to take that offline and get that response for
Right.
Councillor Johansson.
I mean, the obvious one that comes up is the Ferry Road one, where we did get, I think a number of submissions on it, but it hasn't been flagged in here.
We'll make sure
Okay.
we have an answer for you and do
Thank
it
you.
as a written response.
Just the wastewater treatment plant, I understand it's currently with the insurance. We were given an understanding that we would have a report into options for the future by the end of 2022. Do we know when that report is coming, and have we made any budget provision for that work to continue? I'm just mindful of what's happened recently, and I don't have any understanding of the costs associated to the work that we need to do on that in regards to whether we need to make changes and put additional money on budget to deal with some of the issues that we're facing.
Leah, if you can respond, please.
As previous advised, we're currently in the process of working with our insurers, and until that we have completed that exercise and report back to the subcommittee on that, we can not do any further information on that at this time.
So can I just clarify though, because my understanding is I appreciate that there's an insurance negotiation around the damage that's occurred, but in terms of working through the possibilities of what we do in the future, it was always my understanding that that was a parallel process to the insurance process, where the staff would be looking at what the various solutions may be. So is that now, I'm just trying to understand because it's quite confusing.
Yes, Councillor Johansson, as a our insurance matters.
Right, and there's no
more questions on that matter.
There's no time frame for that. Like, is there an expected time frame around the insurance?
We're currently working with our insurers.
It'll come out when it comes out.
Right.
Hope sooner rather than later.
Okay.
You got any more, mate?
And likewise with the Bromley Organics plant. I just wondered if we need to look at any sort of budget changes additional, given what's happened in since we've been out for the draft annual plan. We've had a number of non-compliances. So is there any recommendation around putting additional funding to address the compliance issues?
Leah? Or Mary, whichever.
At this stage, as we'd advised in briefings, there isn't at this stage. There's some money in budget, but there's until putting money in.
Thank you. You're done, yeah? Thank you very much. James?
Thanks. Just with on the UAGC one, obviously if that was lowered as was proposed, the larger dollar and percentage increase occurs for the above median value properties, and there's quite a substantially lower dollar and percentage increase for the below median value properties. Do we have any stats or data, I guess, on home ownership for those, and whether or not they're owner-occupiers? And I guess the question I'm asking there is such a move, although the UAGC is already incredibly low and one of the lowest in the country, would such a move to lower it further, albeit against staff recommendation, would that benefit homeowners more or landlords?
We don't have data at
Don't
that
have any
unit.
data on the home
No,
ownership.
I am trying to.
Because intuitively, I look at it and I think, well, there's probably going to be more people that are owner occupiers of the above median value properties. That the 400,000 type property is kind of like in the wheelhouse of the investor. That's what you want. You don't sort of invest in $1.2 million homes as a rule of thumb. So I guess I just wanted to get a bit of a sense on where the benefit's really going to go. It's not going to be clear cut, because it will be a mixture, but just whether that's 10% or 50% or 80%, I just don't know.
It's a good question, but we just don't have that.
Is there any way that we could do some work on where the majority of the benefit will sit?
So I am looking at some ways of trying to get some information on where rental properties are located in Christchurch. So it is possible that something may come out of that work that would be useful. But it's a wee way away.
Yeah, I really don't know, but so it would just be interesting to get a sense.
It would be,
around that understanding that you're not going to be able to get it perfectly, but just a bit of a steer to inform us is useful, so we know who we're helping.
I think we have to be realistic, Councillor Goff, in terms of whether we could legitimately get that information in the quantity and how much time that might take, or even if we were able to access it.
No, totally. I don't expect that we're able to get a breakdown of addresses of who owns what home, but there will be an organisation surely that has a bit of a sense.
As Andrew says, if you can get it easily, we will get it.
Exactly, whether Stats NZ or something like that has got something like it, would help.
You come in. You come in. Me, just quick with me. Could you throw it forward to the water usage one with the yellow, the red and the blue bar chart on it? There, that one there. Now that says summer 2021. I know we've just finished summer 2023, but how easy is it to at least get 22 in there, or is it hard or easy to give us a newer one just so people can see where they've got to?
Yeah, we can certainly go back and see if we can pull those numbers out quickly.
Yeah, thank you. If don't go to too much grief, but okay.
I think it would be useful if we could have the up-to-date.
Just to see, let people know, all this work that I've gone to, it's actually made a difference in their eyes. Okay, Samuel.
Thank you. I agree with James and the other one to factor in if we can around that data, Andrew, would be around local ownership of those investment properties, because otherwise, you're right, we'd be giving it to potentially overseas people. That rates benefit. Yeah, exactly. But we can work through that. Okay, a couple of questions. They're probably for Leah, I would imagine. So I might just I've written them down. The first one is there any more room we can do on staff vacancies?
I don't believe so. We are continuously looking at that. We did a very good analysis and spent a lot of time on that. And our view is at the moment.
There's not. Okay. Is there, in terms of the other one is, I guess, in terms of the capital program, sort of thinking through, we had the report yesterday to F&P, the number's still significantly higher even when we bake in the inflation and contingencies. Are we confident that that's actually the right number, the 463 of core? Because, I guess where I'm getting to is, to be blunt, where our rates have gone up since we last met, 2%. People are feeling the pinch out there, and we need to be looking at how we can actually manage that properly if we aren't going to deliver that capital program.
Yes.
Yes, you agree we should be looking at it properly?
It's achievable. It's achievable. It's not, as I said, I think the words I use, which someone next to me doesn't like, but demandingly achievable. It's not easy, but it's a reasonable target to have, and it is achievable with good planning and effort and a fair wind at our back and not too many risks that end up hitting us in the face.
So I guess the other side of that is, what have we done substantially different? Because history, repeats itself if we don't do something different. And if you kind of look at, nothing has changed for the last few years in terms of that line in the sand. So what's changed this year? That's meant, except for inflation, which we've baked in, that's going to change that number.
That's going to allow us to do 70 more.
Yeah.
Good planning and good execution, really. I think basically.
No, just the calls, Sarah.
And as I've always said, there are risks. There are risks to it, whether it's consultation risks, prolonged community engagement, or consent difficulties, or negotiations with Kiwi Rail. None of these things are without risk, but the target that we've set and the budget that we've got there at 460 for core is a reasonable target.
Right. So come 1st of July 2024, we'll have a pretty well informed capital program for that next long term plan. I guess where I'm getting to is, we've scaled it back, which is good because it was outrageously unachievable last time. But I thought we always lived in the idea that we would monitor what's happened this year, as we have been doing at F&P, to kind of get an accuracy on that number, and we still haven't got to that point. I wouldn't necessarily ask, but like I say, the increase has gone up by 2% at least since we last met, and I just don't want to let the community down by saying we're going to do stuff we can't.
We'll watch it closely and keep reporting on it, and I suppose the LTP stuff is another exercise, isn't it, of planning ahead. But as you've recognised, it is a significant reset from previous aspirations when they were up around 590, wasn't it? So we've done quite a paradigm shift and looking to achieve, do what we say we'll do. It's a significant shift towards that.
Cool. Okay. The next one is, and Russell, it might be you or it might be Leah, just around the OCR. So the Reserve Bank governor's obviously come out and said that he thinks it's peaked. I'm looking at Australia next week, and they're saying, no, it actually hasn't peaked. It's going up over there. What mitigation have we got in place for the next year to protect us from those interest rate increases that look inevitable at the moment?
I'll start. And that's a great question, and it is a level of nervousness around that. And so the 550 that we're at now was, I guess, not expected, but we had anticipated. Okay, so we had sort of at that level. Should it go higher? We've got a high level of hedging already in place, so it's only new borrowings that we're talking about. So it's just speaking with the group treasurer. He's where we're at. He's very comfortable. But if it was to balloon out, well, then that's a different situation. So yeah, at the moment we're comfortable with it sitting. Yep.
Okay, all right. The next, sorry, Phil, a couple more. The next one is around subvention credits from the companies. I wonder if you could. I don't need an answer now, but I'd just like us to go away and look at what we have got there again, because the rates have gone up significantly since we last met.
Yeah, so we continue to look at that. The big thing with subventions is it's based on the tax years, and of course, so this will be the subventions receipts happen in March next year, so it is in the FY24. But it's related to the current financial year that we haven't actually quite finished yet. So we have been estimating that, and we continue to monitor that. And I will, in the next couple of weeks, we're getting that updates forecast from yourselves. In the next while, I will bring back to you some options. But be aware that even if we can put more up, the downside of that, it's a one-off thing. So yes, we may be able to put more up to actually reduce next year's, but it's a double whammy the next year, because you're actually going to you'll have to repay that too.
What I'm signaling is ability to get that advice.
Yep. So we are working on that advice now, and we'll bring that through to you with the options.
Next ones are in terms of the heads of service. Do they have the ability to look at anything that isn't essential in time for that final annual plan? I'm just thinking, is there stuff that they've gone, actually, the significant pressure on the community, there's a little bit they can find from within their departments that will cumulatively have an impact? Again, I don't need an answer now, but it'd be something I'd just like the organisation to continue. I know you continue to look at it, but we should raise that here. And then the only other two are, the first one is around the capitalisation of OPEX. So I know we raised that the other day. Are we in a position to update us on, or can we be for the next meeting around if we've gone back through all of that?
Yeah, we're in the process of going through that. We'll come back to you next week on that.
Right, okay. And then the only other one is around Christchurch NZ in terms of, I'm just thinking of the bid funding and the like. So we did put a significant amount on budget this year for that. Again, don't need an answer now, but can we go back and look at just whether that is appropriate, again, given that 2% additional increase on people?
So the events funding, the 2.5 million, we will look at that. Come
And
back.
and probably again whether that Christchurch NZ budget is just fit for purpose for the next 12 months. I'm not suggesting drop it.
So the events funding wasn't just CNZ, so we'll just clarify.
So
It was all three.
Two things. Yeah. So not just the bid funding, but actually looking at the organisation and just making sure that again we're squeezing every dollar we can.
Yeah, we're happy
that
to
doesn't
look
jeopardise things.
No, happy to look at that, except the fact that those budgets are more set as agreed. And changing an organisation at this late might be a bit difficult for current year.
I guess where I'm trying to get to is I'm not saying wholesale cuts across everything.
Yep.
What I'm saying is we need to begin to recognise that cumulative effect of small savings, again, when the costs have gone up significantly. Yeah. Cool. Thank you. Thanks, Phil.
Yeah, Pauline, please. Yeah, it'd be you.
Yeah, just a question. I just read this in the question and answers. I noticed that the 28 million of the Capital Endowment Fund is on a term deposit maturing in April this year, so that's matured at 3.11. Obviously, we'd be getting more than that now, maybe even double. I don't know. Is that been factored in? I would assume it would be, but if you don't have the answer, can you just have
Look, I'm sorry, I can't give you the answer to how much we put in there, but understand that doesn't impact the rates. That just sits in with its own fund, so it's
But it's income for us, isn't it?
No, it stays within the Capital Endowment Fund.
Yeah, I know, but we're using that.
We're using, yeah.
So what I'm getting at is then the Capital Endowment Fund would be expected to increase as a result. But can we get some info on that?
We'll have a look at that for you.
Thank you. Cheers.
Okay, Tyrone.
Just on Te Kaha, so obviously we've brought forward a good deal of funding because, I mean, the assumption I'm taking from that is that the project's speeded up. That's right? So that would imply, or does that imply that that there's been a freeing up in supply chains and or the labour market? And if that is true, then what are the implications of that for our other projects?
That's a good question.
I think that they're going. Sorry.
Was some of it was pre-purchase of supplies,
So
that you get, buy, for example, steel at a cheaper price before it was escalating. And they have also sped up some of that design work, so it's not. I don't know what impact that's going to now have on the rest of the contracting market, because this is a big project and will be taking up quite a few resources from the contracting market as it moves through.
I mean, my response to that would be you can't speed things up unless there's additional capacity to do it. So does that mean that we've got more capacity in the market to do stuff like that?
So it's the detailed design that's sped up, and that's been across the main contractor and the subcontractors that are already on the books, and there's been pre-purchase of materials. So you're talking about in further out years when I'm not quite sure what you're.
Well, I mean, thank you, Mary. Right, so if detailed design's been sped up, so a designer is working faster.
Yeah.
Or designers are working faster, or they're just working longer hours, or there are more of them available to do that sort of stuff.
The project's going really well.
Yeah.
So that they preloaded the steel and other things, hoping that it would,
So that's a freeing up of the supply chain, isn't it? I would say.
Well, it depends who else is in there, I suppose.
I mean, we can debate that. Like,
Well,
I think the answer is we don't know.
If that's your question, is yes, it is. They've also done that. Got into the ground earlier and done some of that early work, concreting early.
Right.
So they are probably. The work's been done quicker, so it won't.
They've also secured all the contracts for the sub, so that they've been well organised ahead of time. So
the physical job.
I'm happy for staff to answer this rather than elected members, but
the physical job is. You went to the walkthrough the other day, did you?
No, I didn't.
The physical job is going better than expected, so they need stuff faster to keep up with it. Otherwise, they'll fall into a hole.
I mean, that to me sounds like a freeing up of the supply chain and materials and labour. But anyway, okay, that's fine. We can debate this further.
It's all good news.
Well, we were told that the other day in a briefing that the commercial sector is freeing up. It's the residential still hasn't yet.
You got any more?
One more question.
Yeah.
No, that's cool. That's cool. It's just wondering. Our rating-based growth assumptions. The rating-based growth. Sorry. What are the assumptions behind that? Do we have a sort of a sense of numbers of houses, and what are the kind of what's the sort of the range of that? Like, are we looking at a conservative estimate or a?
So basically, what we do is we look at what's in our rating database, at right now, and we compare that with the start of the year. So we're confident about the first sort of 10 or 11 months of this year, how much growth there's been. So it's just the uncertainty of the next month or so. So we're pretty confident about it. It's perhaps very fractionally on the conservative side. That is sort of traditionally the way we've done it. Longer term, long-term councillors all know that number tends to creep up a little bit.
Right.
We're pretty confident.
So can I add to that?
Yeah, do you want me to go?
No, but I'd like to go, and then I'll let you go if you don't mind. We should be conservative with a very small c on that matter. I would agree.
Yep.
I would. My strong advice, and I'm sure it would be the same from Leah as the CFO, is if you push that number too far and the reality doesn't come, actually you end up with a big financial hole.
Yep, that is
so
perfectly sensible.
Cautiously, and we've probably gone a bit further than we would have done normally this year, and it seems to be landing on the right side. But I certainly wouldn't want to go any further.
Thank you.
Leah, do you want to add anything to that?
That is exactly that. We took more into the draft annual plan to try and actually get that rates down. But normally we were being at 0.8. We took 1.3.
Yeah.
Yep. And usually it's around, in the last couple of years, been 1.5, just over. But you need to remember too, the growth in the last few years has been quite significant. So we just need to be careful that we don't go too far. But as we go right up until that last day of adoption, we will update on your last day, which will only be a few days out. We will have a clearer idea.
Thank
but
you.
It's still never right.
No, that's cool. That makes sense. Thank you. So, is just a follow up. So, is the underpinning assumption there that people or homes are being built in Christchurch rather than bleeding into the areas outside of Christchurch? Would that be fair?
I think growth comes from things like a building consent. You build an extra, knock a building down and build a bigger one. On an existing rating unit, that would be growth. Another one is subdividing land. That in itself increases the capital value slightly, and obviously you build a new houses on a subdivision. All that is growth. So it's more just a question of getting all of that valued and recognised in our system. Determines the growth.
But people have got to live in those houses, so more people are buying houses in Christchurch rather than slipping outside into Rolleston, for example. That's probably complicated. I'm probably over-egging that. Sorry.
So we work very closely with QV to get that as close as we can, and as others have said, we've probably pushed it out further than we've done this year compared to previous years. I think to yesterday, the financial report for April, I think we're about $2.2 million ahead of budget in that space, that won't be the case next year. You know, we won't have that additional. We're expecting might be a little bit, but you know, we've gone quite far out this time in our expectations.
Okay, no, cool. No, that should just about do it, eh? Yep.
Mark, please. You done? Sarah, please.
Kia ora, thank you. It's a huge amount of work to get through for us. On the 17th of May, when we made the decision to increase the budget for Horsell Junction Road, we deferred 4 projects, but we did ask for staff to come back with advice in time for the annual plan considerations around the amount of money needed on budget for these projects for design and engagement. And I'm just wondering if we're going to get that information in time to be able to get that on.
So that resolution from, if it was a resolution,
Resolution
I think guidance
5,
from
yep.
the 17th of May is built into the 25th of May version. So was it 4 projects substituted?
Yep.
In the table in that paper, that is reflected in our version 2 25th of May document that's scheduled here. Is that what you mean?
No, I think the councillor is asking specifically.
Not the substitutions, but we asked for you to come back because those ones had been substituted out. What we wanted to know is, without the big capex spend for the build, which is the main stuff, how much money do we need to put on budget to do the design and engagement, so that those projects can then be built. Does that make sense? So earlier,
I understand.
So that they don't get continually delayed.
Apparently, we've got an answer through our translator.
Acting as interpreter.
Sorry, Lynette.
Lynette says that that there was an answer that there'd be a need for 200 per project for the 2 projects.
So that's for Evans Pass Road and Southern Lights? Yep. So 200 in FY24. Okay, thanks. So
Thanks.
Done? More?
No, that's fine. But I'll have to specify that as
Tyler.
the extra information and
When-
the amendment.
Kia ora. Peter, I asked you a question a wee while ago actually around, I know you might remember, don't worry, around lessening that gap between deliverability, LOS, what the things that we hit, that we deliver on, and the ones that we do not. And there was like a red and green bar that went up against each other. They're in the normal LOS reports.
Okay.
That gap, could that be shortened? I mean, I did ask for, I'm trying to word this question so it's clear. I did ask for it to come back to see what usually gets done to shorten it. I know there always needs to be a red because we want to look forward and try and anticipate to over-deliver if we can. So there always needs to be that red bar where we sometimes won't be able to deliver these services. I'm just thinking about, say for example, we deliver 85% of the projects that we have and the 15% is in the red. Are we able to cut that 15% into, say, a 7%?
You're talking about levels of service now?
Yep.
Okay. Look, the ELT view or the staff recommended view was that we put that at about 85, and that was based on two pieces of logic. One is historical delivery. The other one is the fact that no organisation who sets realistic goals will deliver 100%.
Yeah.
Because there will be either a rain event or whatever. So we don't want to turn around to our staff and say, we're asking you to deliver 100% and make it an impossible goal. That's very demotivating.
Yep.
So the balance was struck at 85 as realistic, and allowing some reality to come in on the remainder. If you're saying, can we improve that performance? The answer, I think, is yes, but we need to think about that because it's the same deliverability question as capital.
Gotcha.
If you say, yes, I can, you actually need to say, and I'm going to show you how.
Yep.
So that's really very much an LTP discussion. And I just want to maybe if I can go back to Sam's question about deliverability on capital, because it's kind of connected.
It's very similar.
Stepping away from the annual plan for a moment, I know you're looking for some comfort around deliverability. The letter of expectation from the councillors around the LTP is crystal clear around deliverability of the capital program. And I just wanted to provide some assurance that in terms of the engineering of that process and what you'll see, Andrew and his team, my team, a group of teams are working towards being really clear about historical delivery, not proposing a big raw program, but rather something that's had a more thoughtful approach, shows historical delivery and shows the rationale. If there is an attempt to increase delivery, what's the rationale? What's the science behind that? So that's the comfort I'm trying to provide around your question in the long term. As for the how do we improve level of service performance, that's really an LTP discussion because it's a big topic.
Sure.
It generally implies a look at resourcing, focus, planning, all those things.
Sure.
Councillor Harrison Hunt, the other context is actually the levels of service that this council has are already high.
Yep.
So to put targets to reach 85% is a pretty stretching thing to have to achieve. My strong advice to any elected member in this room would be that if you want us to be hitting 100%, there is one thing we can guarantee, and that will be failure. Because it just is not realistic or sensible. So that balance act about getting the budget right, along with the staff that we need, along with the ability to do the things we want to do that you set, actually has to be set in the context of realism.
I think that's where I'm trying to get at with the staff that we need. So we made some cuts to try and bring back the rates by putting a halt on staffing, new staff. Can we please, can we elaborate on exactly what impact that may have on in terms of levels of service and maybe even deliverability?
I think that is not as easy as you think it might be.
Yeah.
And you have to set that in the context of turnover rates for every organisation in New Zealand at the moment. So even if you're talking about vacancy.
Sorry, it's new roles that we were looking to.
Not new roles. It's roles that we have in our organisation whereby we either small number we haven't filled because actually we've either struggled to get people because they just don't exist or are very rare, or actually we've taken a look, recognising the pressures that exist and also the potential impact on LTP in the future year as well, and gone, can we do where we are at the moment without putting additional stress on the organisation, because that's the other side of the coin.
Yeah.
So we are constantly trying to think of those things as we move through. So Peter's quite right. We need to have a hefty debate and discussion around levels of service for the LTP and to set the expectations right.
Yep. Cool.
It's a good question. Thank you.
Thank you.
Just need to load, excuse me.
Okay, so I believe we've come to the end. I'd just like to thank members on very good questions and the team on very good answers. And I hope it's actually assisted the public in seeing what we're up to and give a bit of clarity on where we're going. So, sure there's no more questions? Everyone's happy? Good, thank you. We'll close with karakia.
Kia whakairia te tapu, kia wātea ai te ara, kia tūriki whakataha ai, kia tūriki whakataha ai. Haunie, huie, taiki.
Thank you very much.
Thank you.
Sweet.